everybody. Okay, I think we can get started. So hello everyone and welcome to our third AIC workshop, this time on finance and budget. My name is Felix Gandis. I'm the Senior Community Engagement Associate at Resolution Project and one of the facilitators for the AIC. It's great to see you all again today. I'm very excited. Each webinar is really set up to help you for the in-person pitching and to meet with the funders in October. We, again, encourage you to ask questions and participate as much as possible. We mean for this to be very interactive. And we should feel pretty lucky because today we are joined by Howard Levine. He's one of Resolution's co-founder, and he'll share a little bit of his experience with us. So with that very brief introduction, Howard, I'll turn it over to you.
Thanks very kindly, Felix. Good morning and good afternoon, everybody. Appreciate you all taking the time to be with us today. We've prepared a brief presentation here around forecasting and funding in the connection with accelerating impact. This is, of course, meant to be as much of a dialogue as possible. It's a lot more interesting, I hope, for everybody if I spend less time reading slides and a lot more time talking and hearing everybody's questions and hearing how we can be helpful. By way of my background, I'll go through that pretty briefly here on this slide. As Felix mentioned, I'm one of the co-founders and treasurer of the Resolution Project. It's been a privilege to be involved in Resolution's development here over the last almost 15 years. When not working at Resolution by day job, I recently founded an impact-focused real estate fund called Second Horizon Capital, which looks to transform large format commercial real estate projects for community-focused uses. What that means we spend a lot of time looking at here in the US is stressed and distressed projects, including enclosed regional shopping malls, lifestyle centers, suburban office parks, and one-off additional real estate projects that need to undergo significant transition. Prior to that, I'd spent about 11 years as part of the global credit and special situations practice at Bank of America, where my responsibility was really focused on restructuring and credit investing, predominantly in US domiciled companies. And in addition to Resolution, I serve with a couple other organizations here in the US that are not-for-profits focused on youth engagement. Would love to spend a minute before we dive into our agenda, just going around the room and hearing a bit about your ventures and what you're hoping to get out of this conversation and things we can answer along the way. Rather than call directly, I'll certainly open up to whomever wants to be first to share a little bit. And don't all jump at once.
Feel free to come off mute and share a little bit about what you're looking to get out today.
Can you repeat the question? Sorry.
Sure. Was just hoping to hear from some of you a bit about your venture, but also a little bit about what you'd look to hear out of this session.
All right, so I'm with Kekimawi project. My co-founder is James Tayari, and for this session, we just want to learn more about financial modeling and also budgeting, whether it's like quarterly or annual budgeting, but more specifically, I want to like how we can align impact with like financial goals, financial targets, and also just be able to like focus ahead in terms of like revenue projections. But I think basically that's it. But there's more to share, but I'll share later on during the meeting. But mostly just like just being able like to align like impact metrics with like financial goals or financial allocations. That is the budget, yeah.
That's perfect. Thank you kindly.
Joy, since you're on camera, I don't mean to pick on you, but do you want to go next?
Sure, I can go next. Hello, everyone. I hope you're all doing well. My social venture is Mwangaza Cancer Initiative. We are focused on breast and cervical cancer education and screening. What I hope to, we are based in Kenya, by the way, and our target population is women and girls who are from low income communities and are uninsured. What I hope to get from today's session is on how to make sure that we pitch what the funders really want to know when it comes to budgeting and finance, and how it aligns with our short-term and long-term goals. Thank you.
Thank you. Anyone else have anything they'd like to share before we get started into our agenda? Okay, as we walk through, if there are questions or areas that we can touch further upon, again, please don't hesitate to interrupt. This is meant to really be a dialogue, and hopefully I spend a lot less time reading slides and a lot more time fielding questions and finding ways to really make this as relevant a session for all of you as possible. So the way we outline this discussion is thinking about, first, capital model options. For each venture here, there's different ways that you're choosing to raise funds. Some of you are very not-for-profit focused and are looking more at grant money or donation type money. Some of you are in a more for-profit sphere and are thinking about capital raises in a more traditional sense of raising equity or raising debt. And some of you are in a hybrid spot where you're raising capital in a form that has economic ownership, but has an impact drive. The second is really a section about financial background. What we mean by that is, for all of your ventures, how are you validating where you are today? What do you need to show from a historical standpoint to give your funders comfort and direction about where you might be heading going forward? And the third are things to think about when you're building budgets and when you're thinking about forecasts. You'll hear this a little later in the presentation, but one thing you can know about forecasts is every company's forecast is going to be different, right? That you all have different drivers for your models. You all have different impacts you're trying to achieve. You all have different ways that you're operating, but there are some core building blocks and some philosophies that can be helpful as you think your way through budgeting. So starting with capital models. So the first questions when it comes to raising money is how are you fundraising, and what do your stakeholders want? What do they expect from you? What do they expect from your venture? In that notion, when you're thinking about your funders, you want to think about what form of investment you're offering and what's their motivation. You touched on this already with the question of how you're linking impact with financials, right? It's what is your investor's profit objective and what is their impact objective? Which one of them takes priority, and how do they want to see that presented and validated? Some of that is a figuring out your funder and figuring out your funding style feeds into how you're presenting, right? Not every funder is going to have the same desires. Not every funder is going to have the same mix. Every funder is going to have their different objective, and it'll matter to you in terms of finding the right alignment with your donors or with your capital to think about how those objectives align with yours. So when you think about types of funding, we really break it down into three pieces. You have for-profit funding, not-for-profit funding, and things that are kind of in the middle, which would be hybrid. When you're thinking about for-profit funding, your capital usually comes in either equity or debt. right? It's either going to be some sort of common equity, some sort of senior type equity, which is preferred equity, so ownership in your company, or debt capital, some sort of loan, whether it's secured by your inventory, secured by real estate, secured by the company itself, or unsecured, where it's just a loan with the hope of repayment. Most of these investors, on average, have a focus on either capital appreciation, if they're giving you equity capital, if they're giving you seed funding, if they're giving seed equity funding, if they're giving you a series round, or something like that. They want to know how they're either going to get ongoing dividends or how they're going to get their money back with appreciation. If you're thinking about your creditor type financing, your debt structures, your secured or unsecured loans, their focus is going to be around, are we going to get refinanced? Can we get our money back? And certain investors are going to place different weightings around how they think about impact and what sort of impact they're looking to align with. How specific is it? Does it align with a specific topic they're focused on? Does it align with a specific geography they're working on? And it's going to differ from investor to investor. But for the most part, these investors are expecting market rate return for market rate risk. They're expecting some economic profit motive. On the flip side, you have your not-for-profit funders, right? This is going to be more oriented toward non-financial objectives. These generally come in the form of grants or donations, right? They're going to come from foundations, they're going to come from companies, they're going to come from people, individuals themselves, they're going to come from community groups. And their focus in that universe, because they don't have a profit motive, is really built around what is your designed impact. And there's a couple ways to think about that. One is just the measurability of the impact you're providing. The second is thinking about how their capital is going to influence the sustainability of your own organization. We think about this at Resolution a lot. It's if they're providing you a not-for-profit funding in order to grow, in order to maintain, what will enable the organizations that you're building to really self-sustain themselves over time, or have reliable streams of income so that they know that the impact you're having can be maintained over longer periods of time. And then in the middle, you have hybrid funding. This is pieces that incorporate elements of both. They have some profit motive, but less so than a typical just market rate return. So this can be subsidized loans. It can be subsidized equity. It can be a portion of they're giving you a grant, or they're giving you silent debt, or you're giving them equity where they don't necessarily expect their money back. And here they're doing a combination of getting a return on their capital, especially here more often their principal, the money they first gave you, and how much you can measure the impact that you're having. And so this hybrid spot is going to vary a lot. You get a lot more non-traditional in terms of who's the groups who are providing these sorts of funds. I'll pause here and see if there are any questions before I go into financial background. And I'll also ask a question, which is for some of you, if I could have a couple of you share kind of what sort of capital you're looking to raise. Are you looking more for donors? Are you looking more for growth capital in a for-profit context?
Just a quick question, Howard. So for this particular event, are we going to have like angel investors who might be interested in having like a share in the company in exchange for a certain amount of dollars? Will that be part of the conversation?
Yes. So angel investing, thanks, James. Angel investing would fit on average a little bit more in this for-profit funding or hybrid, one or the other, if they're doing it in exchange for a stake in your company. And for them, especially if you're thinking about an angel investor, they're thinking a lot more about growth, right? They're going to be in this appreciation of capital section. What is your exit? How much can you grow? Right? They're looking at it for significant expansion. And so in that context, the angel investor type universe is thinking about a couple things. One is how much can you grow from the capital they're providing? Two is going to be, especially for an angel investor, what's the next round you're going to need to raise? So it's how long is that financing going to last you before you need another tranche of financing? And what will that growth look like? So to an angel investor, they're going to be thinking about the world in a little bit more of an appreciation of capital. As in an impact context, they will have a certain type of metrics that they're looking for, but they're looking for, on average, things that have very large, larger scale growth potential on average versus the investment that they're making. Each one will be a little bit different, but generally speaking, they're really the early stage equity in a company.
Okay, thank you.
So with that, I'm going to talk a bit about financial background. And what we mean by that is, what do people expect for you to show when you start, and what are they trying to take away from that information, right? Regardless of where you're looking to obtain capital, whether it's for-profit, not-for-profit, or hybrid, the people who are making those capital decisions rely on some of the same base financial data to make their decisions, right? So when you think about historical financials, they're going to be focused on your income statement. They're going to be focused on your income statement. They're going to be focused on your balance sheet. They're going to be focused on your cash flow statement. What has your organization done to date, and how has it grown to date? The questions on average that I think come up most often in that scenario is, how much money has gone in? How sustainable is your existing cash flow? Do you need consistent donations? Do you need consistent grants? Do you need more equity infusions? How sustainable is what you have today? And what does the venture need? And what do you need to stabilize and grow your concept? How much money is required to get you from point A to point B? As you're talking to those organizations, generating their confidence around that baseline for you is dependent in part on generating reliable historical financials, that you have tracking tools in place, be it a QuickBooks, be it Excel, but be it something that is robust for your scale, where they're able to look and say, this is what the organization has done, and that they're tracking the funding that they're receiving and where it's going. As you're thinking about what you're trying to accomplish with that, you have a couple of common objectives, I think, that come across most often. One of them is, when you think about this type of capital question, how much money do you need and when, right? What is your capital need? How big is it? When do you need it? And what should that reflect? Because in the end, when you're approaching any funder, on average, the question you're trying to get to is them asking, what do you need? Or what are you asking for? And so you need to be in a spot where you know what that ask is that's appropriate for your organization. The second here is, when making that ask, you need to be showing that what you're asking for matches your stakeholders' objectives, again, profit motive and impact motive, and that they're going to actually get what they're trying to achieve. How can you evidence that process? To do that, that's where we get to budgeting and forecasting. When you think about forecasting, I like to think about the World of Lattice framework, because again, every company is going to have a different style of budget and a different style of impact. But what's appropriate here is two things. One, it is more art than science. There's a lot of what'll show up on a spreadsheet is great, but you're the person who gets to decide what the assumptions are that you're tracking, right? You're the person who's going to be defending those assumptions. And so that needs to be something that fits the framework for how you want the organization to be measured, and how you can, on an ongoing basis, measure the organization. When you're doing this, there's a few different styles. Again, models will always vary from company to company to company, venture to venture to venture. But there are 4 building blocks in my mind that matter a great deal. And that will be common no matter what the model is that you're building. The first of them is sources and uses, right? This is what funding are you bringing in and how do you need to use the money, right? This is a balance of what are you asking for and why are you asking for it, 1. 2, when you're going through a model, you want to be making meaningful and measurable assumptions. What I mean by that is assumptions are only as good as their ability to be maintained. In my career, I've seen people who have really enjoyed making a lot of assumptions in their models. The 2 flaws that tend to come up most frequently there are, 1, they've made too many assumptions, or they've made assumptions that aren't meaningful. They've made a lot of assumptions around things that don't move the needle for a venture, or they don't move the needle for a company. And that's something you have to track and something you have to guess, but it doesn't matter very much. So it consumes a lot of time and resources. And it's an assumption that you're going to have to explain. And if it's not meaningful, it's probably not worth the time. The second is measurability, which is if you're going to make an assumption, it needs to be something you track. If you're making an assumption and somebody says, you put this into your budget, and it's I don't track it, then it's why did you assume it? Right? It's you have to be tracking the things that you're using that are part of your core assumptions. Third here is what I'll call a unit presentation approach. On average, I think people think better when they deal in per something. So, per person impacted, per unit, per hour, per week. Something that gets a more relevant quantification so that somebody can understand what you're doing, but put it in a context that helps them scale it. Saying that revenue is going to go from $10,000 to $100,000, but that's just a broad driver, doesn't really on its own explain a lot. You bringing things into a per type of environment, into a unit environment, will help your stakeholders understand what it is you're doing. One of the things that we talk about, even in a resolution context, is a LiveVine per person impacted basis on how much things are as it relates to per fellow, how much it relates to as a per venture, how much it relates to as a per person. But Life there makes it easier to explain to funders what it is you're driving on something that's more concrete than just a dollar amount. And the fourth is scenario analysis. You're going to have a baseline model that you use, but there are questions that are going to happen about what happens if things go wrong and what happens if things go great. If you're a credit investor, if you're a lender, you're probably thinking a lot more about what happens when things go wrong. If you're an angel investor, you're probably thinking about what happens if things go really right. And then there's you as the founder, who's thinking about what is it that happens that I can see and that I can kind of help predict. So you wind up with scenarios, and typically for a normal model, in my own company, we spend a lot of time thinking about typically somewhere between 3 and 5 scenarios. And you want there to be a series of assumptions that tie to them, but you're doing, at a general kind of standard basis, 1 stress case, what if things go wrong? 1 target case, what if things go as you expect? And then 1 upside case, what if things go really well? So that you can understand what your needs are in each of those 3 scenarios. And your stakeholders can understand the range of potential outcomes. I'm going to pause there and see if there are any questions. So let's talk a little bit more about forecasting. That question came up a little bit earlier, and the how do you do financial forecasts? What do people look for? Here we're going to talk a bit about what you should reasonably put into your models. Again, understanding that every model is going to be different because every one of your ventures is different. How do you think about what a model should be so that a funder, so that it is a more incremental value add to your funders, but also a reasonable use of your time and a reasonable use of their capacity to truly be able to understand your businesses and your ventures, while not getting too lost in the weeds. So 3 things here. When you think about assumptions, timeline, and again, scenario analysis. Questions that I've had come up in a resolution context pretty frequently over the years. One of them is, how many assumptions should there be? To which the answer is again, more art than science. It's as many assumptions as you need to show what are the major levers of your organization, but not so many that you just get lost tracking them all. So the assumptions really get balanced by how important are they? And so that's question 2. Is the assumption you're making important? Does it move your model? If it does, then that becomes a reason to have an assumption. The other piece here in assumptions that's implicit in that is an assumption measurable? Is this actually an assumption that you can validate as part of your ongoing work, right? If you're thinking about if you're thinking about it in a product development type of context, how much does it cost to make a unit of a product, right? That's what can you assume there? If you're thinking about it from how many people will you have on your team and what are their salaries, what are the wages of people involved in each part of your ventures, how assumable is it? And so you want to make sure that if you're making an assumption, you have something to truly stand on for it, and in which case it becomes a lot more valuable. And the third piece kind of comes back to something we touched on a bit already, which is, does the assumption add incremental value? Is it an assumption that drives your model, or is it an assumption for assumption's sake? You really want to spend more time in the first, because when you're talking people through your models, you want to be focused on the assumptions that really drive what your funders really drive meaningful potential, meaningful outcomes for you, so that your funders can readily understand where the real pivot points are. The second thing that comes up a lot is timeline. How far out can you look? In my experience, models, the farther out you go, the less accurate they are, right? So if you're thinking about how far out can you model, it's in our world, it's typically, in the world I work in by day job, it's typically a lot more focused on 1 to 3 years rather than say 5 to 7, because no one really has that good a crystal ball. But it's thinking about your forecast timeline and the depth of your assumptions around how far out you can predict them. Different constituents and different stakeholders are going to have different thought processes, right? The closer you are to, if I think about it in an angel investor world, I'm going to think about it as 5 to 7 years out, how much could this have grown? If I'm thinking about it from a lender backed by inventory, it's what's the company going to do? What's the venture going to do in the next year? If I'm thinking about it from a donor standpoint, it's does this help achieve the impact outlines I want? And does this capital help fund the organization through its forecast period? And depending on how long you're asking for their commitment, we'll kind of tether to how far the timeline needs to go. And then here again, we'll talk about the importance of different cases. Thinking about the world as what happened, thinking about the what if. It's not just one model, it's this is my target, but what if things go right and what if things go wrong? In assumptions for predictability, things to think about. How much control do you have over the assumption? How much comfort do you have with the assumption? And what information would change your assumptions, right? If I'm thinking that I'm going to go from selling 100 units to 300 units, how much can I control that growth? How comfortable am I that I could scale to do that? And if I got new information, what would happen? What would make it better and what would make it worse? In that, when you think about modeling, keep in mind that complexity is not always better, right? You want to think about assumptions that you have comfort with and assumptions that you can validate, but just having more assumptions or making them more complex doesn't necessarily make them better, because again, models are just models. And they're tools for helping you forecast a financial future. They're tools for helping you forecast an impact future. But in the end, they're just indicators. They're not perfect and they're not fully predictable. So the harder you make them to forecast, the more you're making life, the more you may be making life more of a burden for you to manage. This touches a bit on what we talked about, what I mentioned before. When you're thinking about forecasting, durability is really important. You want to build a model where you track what you forecast. If you're building, and this is true for impact or for finance, it's if you're going to make assumptions and you're going to talk to stakeholders about assumptions, track the same things you're modeling. Don't use kind of one set of things which are here is what we hope to affect and then track something else. Making sure that you're living in that will make your life simpler and will also make it easier for your stakeholders to assess your progress and for you to assess your own progress as well. When you're in a model situation also, you're going to be updating your models with some regularity. Usually it's not just a one and done. Most commonly, annual budgeting is the pretty frequent tool, but for you from a management perspective, you may find you're more consistently living in a monthly or quarterly update situation. How am I tracking versus my budget? And for that, being able to conduct a variance analysis, being able to compare what you budgeted versus what you did actually, makes a big difference for decision making. And makes a big difference for thinking about how you respond when circumstances go as you predicted, better or worse. Being close to your model again isn't always good, right? It's a model is a tool for what you want to have happen, but if you have upside variances or downside variances, you're going to want to understand why. And so making sure you're in a spot where you're setting a structure where you can regularly evaluate how you're doing versus your budget is really important when you think about laying out your structure. I'll pause there and see if there are any questions. Okay. Now I wanted to spend a little bit of time just talking about building blocks and kind of what are the pieces that are here. And I know some of this has been touched upon in prior materials within resolution. But keeping elements of how you think about building a model. When you think about building a model, it's kind of a long journey. The endpoint is usually a spreadsheet, but there are steps that you're taking to think about how it should be built. Right? Before you start building a model, set your overall objectives. It's a lot easier to kind of keep the pinpoints of what you're trying to accomplish with the model you're building if you know where you're trying to get to from the beginning. When you think about your cash flow forecasts, think about your primary drivers, which are income, expenses, and capital, right? Income, if you're thinking about world in a product space or you're thinking about world in the services space, right? It's what is my pricing, what's my sales, what are my volumes? Expenses, what are my operating costs? What are they comprised of? Labor, rent, materials, anything that fits your cost and anything that's meaningful in your cost base. And then capital. How much do you need to start? How much capital do you need to put in your business or your venture on a regular basis? And how much money would it take to expand? And what sort of things does expansion involve? Which again is going to be very different for every type of venture. We talked a bit about unit and impact forecasts, where it's thinking about life on a per basis. And so that you're able to quantify the units you're doing, or what it costs per unit, or what your revenue is per unit, and what your impact is per unit. Capital structure planning, which again comes back to the beginning of the presentation. What are you raising and how are you raising it? Is it donor money? Is it grant money? Is it traditional for-profit capital? And what are their expectations? And what is it that you need from that capital? And what is it that you're providing to those stakeholders? And then scenario analysis. So I'll pause here for questions. I know there's pieces here that we can dive more into and try and talk about how it affects each individual venture a little bit differently. I'm going to touch on a couple things that were brought up at the front end of the call. One of them was aligning impact with financial targets. It's incredibly important to a particular set of stakeholders to make sure that alignment exists. And the way you really kind of validate that is by setting your impact targets up front, and by setting the nature of what you're trying to impact, so that both of them can be measured side by side, and so that you can be presenting them to your stakeholders side by side. One of the things in my business now that's important from that angle is presenting to your stakeholders that it's not by placing it as part of your normal reporting structure, how you're doing impact. You're showing your stakeholders that it's as important or hand in hand important with your financial results. How and where you present that can make a big difference. And in addition, when you think about impact, we think about it in a couple ways. One of them is how are we doing things directly quantifiable? What units are we measuring? But the second is also the stories of impact, because for a lot of stakeholders, the numbers are important, but understanding the specifics of the why it matters can make a great difference to the stakeholders that we've seen. It's not just we impacted 400 people. It's how did you impact them, and why is that important to those people who you've touched? When thinking about pitching what funders want to know, each funder's going to be a little different. Right? It's one question I'd encourage you to ask is, what's the funder's objective? Right? Because funders aren't all the same. And understanding what their objectives are, you can figure out kind of how you align and if you align with them. To some degree, either concurrent with or before you make the pitch. Not all funders are compatible with every venture. But if you are in that spot, from a finance standpoint, what funders most commonly want to know is, are you accurately tracking your money? Are you accurately tracking your operations? And as they provide capital as part of your growth story, what's their capital going to accomplish? What's the impact they're having on you? And so when they look at that again gets back to a understanding what the capital impact is going to be. How many people will it impact on one side? In what ways? But also what is their funding going to do? What is their funding going to accomplish? Is it going to fund your day-to-day operations? Is it going to help you grow? Is it going to help you buy? Is it going to help you, buy a new facility? Is it going to help you buy new inventory? Is it going to help you hire new people? And so understanding what that capital is for is really important to basically any funder. But different funders will have different things that they like funding. Different funders will have different things they're hoping to influence as a result. So I'm going to pause there and again, open it up to questions and a conversation here.
Please feel free to either come off mute, or drop your question in the chat.
I guess my first question is just to like clarify on terms of the forecast, the financial forecast. You mentioned that, you know, you have to, we cannot predict as far as maybe 5 years, 7 years, because we don't really know much, right? So the recommended like time frame or timeline is like 3 years, right? That's what I got. Like 2, 3 years. Is that?
It's going to depend a bit on the type of capital you're raising, right? If you're looking in the angel world, it's going to be a how much growth could I get over a longer horizon. But what you know is the closer in you are, the more accurate you're going to be. The farther out you are, the more you're taking a guess. On average, that's why you get kind of the difference between, this is going to sound a bit weird, but the difference between a direct budget and a forecast. A budget, in my mind, is a 1-year outlook, right? It's pretty detailed. It's where am I going for the next 12 months? What do my capital need for the next 12 months? Because I can generally predict my costs for the next 12 months. And I think I can predict my income for the next 12 months. And I can do it with a good amount of granularity. When I go out farther with a budget and set with a forecast, the certainty level is going to go down, because I just don't know exactly where the trajectory is going to go in the interim. Usually what I see work most is 3 to 5 years, because it's still got some trajectory where you have a bit of line of sight, but it's not so far out that it's not necessarily meaningful to the funder. We can talk a bit about funders' timelines, right? There's if I think about a donor's timeline or a grantor's timeline, that's normally on average, not always true, but on average, it tends to be a little shorter. Right? If I'm looking at an individual donor, they're probably thinking about life in the next year. I gave you money, I gave you capital today. What's that doing for you now? If I'm thinking about it from a lender standpoint, where they're lending against your inventory or they're lending against real estate, it's however long the loan's going to be. On average, how long could that be? Depending on your context, 1 to 4 years, I think would be the most common. And then you get to kind of the longer term, which is an angel investor type notion. If they're like a Series A investor or a pre-seed investor, but they're buying a part of your company with a profit motive, then they're going to think about the world. They can think about the world in slightly longer horizons. They can go out 7 to 10 years and think about how big could this be. So each funder is going to have a different timeline. But when I think about, from my own experience, kind of what's been most robust for a budget, a year, because you can divide that up by month, you can measure that variance monthly. When I think about a forecast of talking to investors of where an investment could go, typically it's going to be closer to 3 to 5 years, but with fewer assumptions, right? A budget's going to be pretty detailed, and a forecast is going to have fewer assumptions, because there are only so many things that I can truly guess with that type of specificity 3 to 5 years out.
Thank you, Howard.
Thank you.
Audience asking, I have another question, sorry. In terms of the pitch, so I do know that the pitch has to be very interesting. I've done one before, but I don't know specifically for funders, because before it was more of a competition, but this one is more of like funding based. In terms of financials being presented in the pitch, do you recommend having like a slide or so that would describe, how your projection is going to look like, based on the amount of funding that you have? Or do you prefer, like, do you recommend just having like, those documents available somewhere so that, whenever they're asked, you can always pull them out and, explain what's going on? Like where would these financials go in terms of the presentation itself, besides, just having the knowledge itself to be able to answer questions?
So I think each person you ask is going to have a different answer to this. I'll share my personal fundraising style, which is I kind of have 3 pitches that exist. One of them is a 90-second version, right? That's the quote unquote elevator pitch, which is usually going to have very little financial detail, but enough that somebody's going to find the main things that matter to your model, or enough things that somebody's going to understand the main things that happen to your concept. The second one is usually around 5 minutes. And there's usually still very little detailed financial information in there, but enough which is say, here's what the growth potential could be, or here's what your repayment is, or here's what your impact is. And then you get the longer pitch. Then you get to something that's more like half an hour. And if I'm thinking about like in the half-hour world, what I have done is, you have a couple slides that really graphically lay out potential. They don't really include your full model. One, because on average, it's going to be different sensitivities for every person on a call and for every person on this call and every fellow, but it's how much information do you want to share? And how much information is appropriate to share at any point. But it's a couple slides that are digestible. I prefer to do less tables of numbers in those types of decks. To your point, I'd rather keep that in my back pocket. And if you want to have that conversation, you can take out your full model and go through it. Otherwise, my general experience has been if you leave a page of numbers in front of somebody, their immediate intuition is to flip to that page, start reading the numbers, and stop listening to you, and just go and focus themselves on the page, which can be okay in some scenarios, but for the most part, it's your pitch. You want to be the one doing the talking, and you want them focused on you. So if you give them some graphical representations of potential, of a couple key bullet points, revenue, expenses, number of people impacted, the things that are charts and a couple slides of them, that will keep them from spending our entire time doing, you can't see what I'm doing, but doing this while you're presenting. Because as a presenter, that can be really irritating because they've stopped listening. And also from your point, the other issue is when you're trying to explain your business model and you haven't explained your business model and they're already staring at the numbers, you haven't told them how it works. So they're looking at a bunch of numbers. If you show me a page of numbers that I don't need, I'll give you it. This is a quote my dad likes to say a lot. Okay. If you take a test you don't need, you get a result you don't understand. And so this is that same notion. If you give somebody a page of numbers that they don't need, they're going to get to results that they can't explain.
Okay. All right, cool. I think that's fair. Thank you so much, Howard. That really provides some clarity on what we can prepare here.
So maybe one more question before we wrap up the workshop.
Can I go again? Sorry. All right, cool. So sometimes you get asked a question that you don't know the answer to, like, it's something that has to do maybe with like a scenario, as you were saying, like a scenario case, but maybe you've never imagined your venture going in that type of direction, but somebody has asked you that question anyway. And you don't have the numbers to back it up. You don't have the numbers because you have not really run the numbers yourself, but you have like a minute or two to respond to a question. What do you do in such a scenario, and how do you respond? Let's say it's a question about impact. Let's say they ask, what if this happened? Let's say I'm in Malawi, right? Maybe the government now has introduced this law. Now you can no longer produce this X amount of maybe units because of such. How is that going to impact your numbers? But you don't know specifically because these are external factors that are beyond your own sort of understanding so far. How do you respond, and how do you come out of that? How do you survive or such a scenario in a pitch or in a conversation?
So 3 comments. 1, it is totally okay to say you don't know, right? There are ways to structure that statement. So it's I don't yet understand that. That's a really good question. Let me come back to you. There are ways to say that you don't know. And that can be depending on the nature of the question. If it's totally oddball and there's no way you know an answer to it, but you can figure it out, but it's just you couldn't even you couldn't even take a guess at it. Let's say it's that type of question. It's okay to say that's something I can explore and come back to you on. It's okay to say, I don't really know yet. That's a really interesting question. I want some time to think about that. If it's a question that you know directionally, but don't know specifically, giving that type of answer is also viable, right? Then you can say, I don't know the specific answer. I could work more on it. Directionally, I think this is where it would go, but I need to validate it. Directionally, I think this could be the outcome, which gives you the time to say that you can rework it and validate. The third thing is what's not to do. Don't make it up. There's a number of reasons for it, but always making up an answer is a spot that puts you in a really precarious situation for a number of reasons. One, if you say it with confidence and you come up with a different answer, that's normally not going to evoke confidence in your stakeholder. Two, I've seen this particular one play out more in my old day job, which is you'd find people who would ask questions that were sufficiently complicated to which they already knew the answer. And if you're in that scenario, that gets really problematic really quickly from a credibility standpoint, from a managing that confidence standpoint. So I would say if somebody does that, if somebody does ask you that style of question, one, totally okay to say, I can look into it. Two, if you know the answer directionally, perfectly fine to take a directional guess. But three, don't create answers if you don't have them. That should keep you pretty well squared away 95% of the time. If it's a weird question, again, it's a pitch, it's a structure. You have your discussion you want to have with them. They have their questions they have of you. In fact, in some cases, find it okay for them to have a question that I don't have the answer to. Why? Because in a weird fundraising kind of perspective, it necessitates a second conversation. Right? It continues the dialogue to say, that was a really interesting question. Let me come back to you. And it gives you something to talk about in your follow-up. So that's actually how you can also take a question you don't have the answer to and turn it into an advantage for advancing a conversation.
That's a good. Yeah, thank you so much. Yeah, because I think we would meet different people, different companies that we don't have, like, a background information. So sometimes, we may not know which direction they're going and, how to respond to certain questions, especially when it comes to things that maybe are beyond our understanding at the moment. We don't know, maybe they're just things that we have to predict, as you're saying, forecasting. We don't know what's going to happen. If maybe COVID could impact this and that, we have no idea. So, yeah. Thank you.
One other thing you can have in that conversation is and I know this is slightly tangenting, but it's if they're asking you a question and you don't understand why it's relevant, which can also happen, it's also okay to go and say, can you help me understand? Can you help me understand the risk you're identifying? Can you help me understand what concerns you about this? Or can you help me understand kind of where you think that might lead? Because we got those questions a lot, where it's the question may be a reasonable question, but it may not have anything to do with the problem. And so if they're asking you a question that seems oddball, it is totally okay to also try and figure out why they're asking the question in the first place. And then if you're in that spot where you understand the real risk they're getting to, or the real question you're getting to, you may be in a better situation to answer the question.
Thank you. Bernard, did you have anything to ask? Or are we sorted?
Yeah, it's all good. All good, thanks.
Thank you. That's my co-founder, so we're trying to get the best we can out of this. Yeah.
Well, wonderful. Thank you so much, everybody. There's still opportunity if you have other questions that come up, please feel free to reach out to the aic@resolutionproject.org email. We'll be happy to answer them for you. It's on the slide right now. A huge thank you to Howard for taking the time and for leading us through this wonderful session. I know I learned a lot from this. As you all know already, we'll be sharing the recordings of each session for you to, so be on the lookout for that. Before I let you all go, a quick reminder that our last workshop on pitching will be on October 6th at the same time. I know a lot of you have questions about the funders that will be taking part in the EIC. We're preparing a living document where we'll give you a little bit of an overview of some of the funders that have already committed, and that document will be updated on a weekly basis with new funders that come on board. So be on the lookout for that as well. It will come from the AIC@resolutionproject.org email. Thank you all for taking the time to be a part of it, and thank you again, Howard, for helping us out and sharing some of your expertise with us today.
Thank you, Felix, and the entire resolution team for putting this together. And thanks to all of you, our fellows, for being part of this. Really excited to learn more about each of your ventures and see how all of you progress as you continue along. If there's anything that we can be doing to be helpful as you continue along that journey, we're always here for you.
Yeah, thanks, Howard, and thanks, Felix. So amazing.
Thanks,
Thank you.
everybody. Have a great day.
You too.